Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good afternoon, all. Ira Epstein of Linn Associates with your financial market wrap-up for the close of business and the opening of the new trading day. We're basically, believe it or not, trading already for March 1st. Yep, February ended, and because I'm after 5 p.m. Central Standard Time, I'm 5:15, these are quotes for the beginning of the March 1st session. Yay! What does March do? Comes in like a lion, goes out like a lamb? Well, we'll see what's going to happen here. A big stock market break today, late in the day, and it just kept feeding on itself. Okay. You know, one of the things that has bothered me is I'm not showing you in the relationship of maybe Fibonacci numbers where the market is in the grand scheme since it peaked out on January 28th, fell apart, and has gotten a bounce back. And I'm going to do that right now. So let's go to this chart, which is the March S&P 500 index. And what has happened is the market peaked out where I've got this number here. I don't care if I'm the exact number. I didn't bother making it work to the exact thing. I'm close, believe me. I'm within, as they say, a hair's breadth of it. It dropped all the way down right into this level here and then began the bounce. Now, if you take a look, what happens on Fibonacci is you start getting retracement levels. The market got through the 62% retracement, probably got up overall towards a 70% number, and has since that time been falling back. A 50% retracement level is right at the 2700 zone. You're at 2716. So what the market has done is you had your first correction since 2016 of this size. Might have been before then. I think it was around then, going from memory here. You've gotten a bounce. The market's pulled back, and I think traders are trying to figure out what happens from here. I made a statement, did it on Fox, I did it here to you, that when this market began that, I said, at least until I see different, I think the character of the market has changed, and it's no longer the market that was always forgiving. No matter how poorly you bought it, the market went up. Now, if you do it wrong, you're stepped on. You're squashed. It's that simple. As we're seeing the correction happen for the week, we're down 32.5 points. Support back at the 2691 level. So we've got two elements here. We've got the 2700 level, just a 50% retracement zone. We've got a market that's saying that the 18-week moving average of closes is 2690, so those numbers are fairly close together. When I come to the daily bar chart of activity, I put on the swing lines, and I still have a pattern of higher lows and higher highs. Therefore, this market, after that correction, rephased itself and began another uptrend phase. If it's going to slip, you'll know so in short order, especially if it were to come down and take out the low right here. This low was 2682. So there's a common theme that's starting to develop in my brain, for whatever that's worth. 2700, 2691, 2682, all within, in rough numbers, 18 points of each other. So that seems to me first to be an important zone that the market should hold. If it doesn't, it can resume again another leg of this correction. As you already can see, the 18-day moving average of closes, not the week, 2695. 2694.5 to be specific. So I get credence to everything I'm saying. And the 100-day average, well, you may go down there, but to do so, you've taken out other key numbers. That level would be 2665. So there's nothing on the market yet screaming huge correction coming, but getting under the lowest of these numbers, 2665, would make this chart extremely ugly. Got it? That would be how I interpret what's going on. When we see the Bollinger Band, we couldn't get up to the top band. We certainly are nowhere near the bottom band, and momentum is pointing down in the market. So we have a market in an uptrend that has bias to the upside because it's trading over the 18-day average of closes. On pullbacks, I would not be surprised to be support come in at that 18-day average, and you don't want to see this low number right specifically here at 2682 taken out. So I think the pros are probably going to play that type of game back and forth and see what they can do. Do I know? I don't know. It's a guess, educated guess, no more than that, and certainly not a trade recommendation. In looking at the Nasdaq, the difference is in momentum. I have an embedded reading. So until these numbers, both of them get under 80, and they've been now 3 days in a row over 80, actually 4 as you can see there, I think this market gets supported on breaks. I think what the pros will do is before they support the market at 67.03 and a quarter, if it should get there, they'd make certain that you don't lose this number. If they see the red line crossing down on the stochastics the traditional way, they would think momentum's letting loose, and then if they took this number out, they'd probably start talking maybe they can get back down to the 100-day average. But what's the trend? Maybe I've got to stop there. There is no trend the way that I talk about this. You have a lower low and a higher high still in a market that does have an embedded reading. That overrides everything. And that means this market is in the bull camp till that's lost. In the Dow Jones, you have a market that's got the higher lows and higher highs. Like the S&P, it couldn't reach up to the upper Bollinger Band. Support is the 18-day average of closes, and that is a number. Do you think the pros will support it? I have my doubts. And the reason is because I'm overbought. If they buy it at 24,860, they'll probably be looking hard at this low, 24,576. So do they want to risk that amount? Well, that's going to be up to them. I know that how I teach chart patterns and I'm not seeing anything that's getting me excited. In the Russell, the market fell apart today. Now you've got higher high, lower low. The market settled under the 18-day average, under the 100, and momentum is turned down. So I have downside bias. I have a market that is not trending in the sense of, in a downtrend, making lower highs and lower lows, but it has certainly been in the pattern of a higher high and a lower low, and it's staying there. It's a whipsaw, but it's developed a lot of downside momentum at this point. In the VIX had an inside day. It didn't take out yesterday's highs or lows. It has an embedded reading. Keep your eye on that embedded reading. If it pops over 20, it's a strong sign that prices are going to go back to the 18-day average of closes. I am totally not surprised that the market couldn't continue down. As I told you, I've thought that this whole area here that it based from is going to be a hard area to go through. That does not mean I've turned bullish. There's nothing to turn bullish on this chart. Losing an embedded reading might mean you get to the 18-day average. You'd have to close over 23.11 tomorrow, and then you could say you'd have higher lows, higher highs, assuming today's low is not taken out. You go through yesterday's high, and you close over that number. Then you could argue that the market's getting back into the bull camp. On TLT, the market today got to 118.83. It has still not been able to take out a prior high. It does not have a chart pattern that is favorable. It has lower highs, higher lows. That is not a trend. The market did get upside bias today in closing over the 18-day average. Momentum is already up. If the market can click over 118.91, I would think that the bulls become enamored, and they would think that wherever that Bollinger Band comes in, that could be where the market gets a cover to. In the T-bond market, we are open tonight, as you can see. If we take a look at the highs that we made today, they were 143.18. If we come back here at this high, that was 143.26, and so is this one. You had a double top. You've come back up, and tonight you're sort of drifting. What I don't like on the chart is that momentum is up. The bias is up, just like on TLT. On this, I've got lower highs, higher lows. Don't know what to do with a chart like that. 10-year notes, higher lows, higher highs. A little bit different of a pattern here. The market's refusing so far to get over that line in the sand, that 18-day average of closes. If the market can clear 120.14.5, it might be able to add more to that and get to the upper Bollinger Band, but I'm suspecting in the market that we're going to see one of these sideways patterns develop out of the Bollinger Band. It's got all the feel of that. Is there anything here on the horizon to drive yield sharply lower, not higher? I don't see that. So I see a market that had a heck of a break. I mean, a heck of a break since the beginning of the year, and it seems to have digested that, and now it's just sort of bouncing back and forth. In the dollar index, we were talking here about this market having an outside day down on Monday. That is, it took out the highs of Friday, took out the low, closed lower. If you take that out, often it's a trap for the bear. In other words, if you have an outside day down and you take out that day's, the previous day's high, you launch a trap. There's several places it could go and none that it has to go. That's an important thing. But if it's going up, because my 100-day average is way up there, one of the logical areas I look at is the upper Bollinger Band. Remember, it's caught right now the bears. So the market started rallying. This was Tuesday's rally. This was today. You added more to it. You're knocking on the door of that upper Bollinger Band. You are getting overbought. The market would have to get over this Bollinger Band and start pushing on to keep it going. So what it does here, I'm not exactly certain. I would expect to see professionals taking money off the table against the upper Bollinger Band. And because you had an outside day up pattern, it's not my favorite pattern to initiate new trades again. So I'm probably more of a looker than anything in these currencies temporarily. It's the flip-flop in the eurocurrency. Right back here, the same way that we had this, if we take a look, here's Friday's action. Now you get on Monday an outside day up. You take out that low. You know what I'm going to tell you. I'm looking for the Bollinger Band. It's the closest of the key numbers here, and you're making your run to it. Whether it hits it or not, I'm right already in the sense the momentum is doing what I said it would, and that's what you're looking for. In charting, I wish I could thread the needle the way some people do. There's the guys that have that ability way beyond my levels. I think I'm pretty good, but I know some floor traders, and I watched them all my life. They were the best I ever saw in some of this. But in looking at it, I think we've got the momentum picture. I feel really good on the British pound. If any of you get our price counts, you know that I write for the firm the financial price counts now. And if you don't get them, you want to go to our website and sign up. And this was an area on this rally I kept telling people that look at the price count. I think it's going to make a run towards right in this zone. It did its job. The trend is down. You are oversold. This should be a support area in the pound temporarily. If it gives ground, there's a lot of room in this. Could it go back to the 132 level if things go bad in terms of not making the headway Miss May wants there? It could. But I'm not a fundamental trader. I'm a chartist. The trend is down. It's oversold. It's hit a downside target. I expect to see some profit taking. That's all. The Japanese yen is a son of a gun to trade. It's keeping its upside bias and has for most of this year, as you can see. It's been able to stay over the 18-day average of closes. It does not have a pattern I like. It's got a lower high, higher low pattern. Momentum has sort of flattened out, no longer in overbought territory. So a couple of things. Number one, the bias is up because you're over the 18-day average. Momentum is lacking, and I really don't have a pattern to tell you to trade off of. The legacy, because it started with the higher lows and the higher high, is still in the background. But once I see that lower high pattern develop, I tend to walk away. In the Bitcoin, I'm watching momentum gradually picking up downside here, not upside. I saw a market that went from the lower Bollinger Band, just missed hitting the upper Bollinger Band, and I'm seeing sideways action develop. Wouldn't be surprised if the 9,500 becomes a target zone that it starts playing against as it tries to figure out what to do. Who's in control, though, right now? The bulls. First off, going short over an 18-day average, that's something you decide. It's not the way that I teach charting. So I see the bias is up. Momentum is fighting that because the market is in overbought territory. It has a 71 reading. Not keen about that, but I can argue that the two things on it. Theoretical support, the 18-day average, resistance, 11,855. The Brent versus the this is the Brent versus WTI crude. I'm bothered by this. One of the markets is open, the other isn't. That's because I'm doing this later. Dumb me. And that's what's going on. Until the Brent opens, you can't go by that. The market fought a battle, though, in the $4 range today. Here is, as you can see, this is Brent. And on the Brent, this is still Wednesday's close, and that's why one is against the other. This market closed 65.78, the low of the day, 65.43. You can see the 18-day average, 65.35. You might say, well, do I expect to see professional buying there? I don't. And the reason is the market is so overbought and momentum's trying to turn down a little bit. So yes, the trend is up, the bias up, momentum is down. If you're like I am and you look at momentum, it's a pretty important filter to me. So I can't argue that the market's not in an uptrend. I can argue that the momentum's not favoring it right here. As we take a look at the crude, you're down another 4. That's why that whole spread is a little goofy. You've got higher lows, higher highs. Now here's a little difference. Both numbers are now under 70. So this market is no longer overbought. I can see pros buying it right against this 18-day average. They might put stops under this low, and they're looking for a bounce in the market. Now, if you had a heck of a bounce, the upper Bollinger Band, I don't see us going back up here anytime soon. You need some event to make that happen. You've got to cut off oil supplies in some way. If I see anything as a fundamentalist in the market, I'm always concerned what happens when refineries go into the maintenance as they switch from winter to spring-summer blends, and that's generally less demand for that product. In the gasoline, the battleground is the 100-day average and the 18. You're still fighting a battle. You still have the pattern of higher lows, higher highs, but momentum is pointing down and bias is down. Again, not a clear picture as I see it there. And in the nat gas is still in its bullish mode. Now, admittedly, it's climbing at a gradual rate, but it's not overbought. It has the pattern of higher lows, higher highs. If it can pop here, and that's the if, can it pop to the upper Bollinger Band? If it gets now under this 266.10 level right here, that day's low, right? See it? What could happen is you end up with a pattern of lower high, then lower lows, and you put back into play the 261.20 level. However, at this particular moment, things still look bullish. I want to remind you about my good friends at Modern Trader magazine. And I love this magazine, as you probably know. And no, folks, people have asked me, do I get paid anything for them to come on and do this? The answer is no. If anything, I'm just trying to bring you something that I think is real good for you. This is the March issue. Covers stocks, FX, derivatives, futures markets, option trades galore. Why not learn something? And then the articles in it, they're top notch. I mean, they're written by some of the best market technicians out there to teach you how to use different ideas, how to use different formulas, different thoughts on the market. Then they wrap it all up with other talk about the markets. Oil prices have limited upside. I'm thinking that too. You know, ideas there. And then this is what the articles look like. It's a $79 a year value. I could say, buy it, what's the big deal? They're great people, but if you get hold of us or go through our website, we can make it available for a year for you for free, all by email. That's how I get mine. I think it's easy to work with. Call us, go to our website, click up here at any point, or you can always, if you're watching us on some websites underneath us, it'll say, click here for Ira's information. Hope you like those Fibonacci numbers. If you did, let me know. I will talk to you all tomorrow.